Hey everyone, hope you're all doing well out there. This is your March market review and a little bit into April here as well. So the reason I'm bringing this to you after the first week of April is because of everything that's been going on the earlier part of this week, which I wanted to wait to get this out and not leave out the big moves that happened here Thursday and Friday. I'm shooting this here Friday, the 4th. So I wanted to give you the full update on everything that's going on, my take on that. For those of you that have never watched this video or aren't one of my clients, the reason that I put this video together is to give my clients the straightforward information with no media spin or political angles about what's going on in the market and the economy, and just really give my clients the update on their portfolio and my take on what I think is going on and why. So especially this month, really good time to kind of cut through a lot of the media and political stuff that's being thrown out there. So update for you. The first chart I have up here is a chart showing the returns of the market for the year. So for the year, we're down, pretty significantly because of the last couple of days, especially, we're down double digits for the year, a little over 12%. So, and just since the middle of February the 19th was the peak. We're down about 17% from that point. Yesterday and today, market's down 4%, roughly speaking, in the last just couple days, both days combined, down about 9% in total. So pretty big movements going on. And I'm going to give you, instead of like what the media is giving you with the doom and gloom, because that's great for them to sell ads, it really does nothing for you as an investor. And really, it misses the whole point of the opportunity that's happening right now within markets and ways that you can take advantage of it. So never exciting to see markets drop off at all. I'm always sitting on the same side of the table with you, but the reality is that stocks do drop, and it's healthy for stocks to drop off periodically. And one of the things I'm going to show you a number of charts here, talking through kind of where we're at and the opportunity of where we're at right now. So the first chart I'll bring up is a chart that is a 1-year chart of the S&P 500's percent movements. So as of when I printed this chart out here, I'm April 4th at around 1:30. So, markets are still moving a little bit, but as a whole, we're down about 2% over the last 12 months. So if we were to just rewind back to February 19th, we're actually up close to about 18% at that point. So really big drop off in the last month and a half here. But if we look back, this is really just rewinding the clock back to where we were at the very beginning of August, which at that point, the market had dropped off a little bit from the very beginning of the year. But at that point, we're also up double digits for 2024 too. So it's something to kind of keep in mind where we were and, where we've gotten to even with this drop off. We're still pretty, the market's still come up a lot over the last couple years, especially. One of the interesting charts I was looking at just to kind of pull data was looking back over the last handful of years, because February 19th of 2020 happened to be the peak of the market at that time. That was right before the big COVID drop off. It also happened to be the peak then this year so far. So I thought that was just kind of, the way the dates line up, numbers are just, it was an interesting little fact I saw. But looking really at the data though of long-term where the stock market's been, stocks average about 9 to 10% if we look back over the last 100 years. So over the last 5 years exactly, the market is up over 100%. So, and that's going back to beginning of April of 2020. So that's when the market at that point had already bottomed and actually was coming back up. If we stretch it back to February 19th of 2020, the market's up a little over 50%. So if we're just using, basic math here, that's, about 10% a year, which even with the drop off of COVID, with the drop off that we just had here, that's picking kind of the worst day in 2020 to have invested, but, and fast forwarding through today. But if we fast forward, we're right at the average of 10%, which not so surprisingly, there's a financial or investment theory out there called reversion to a mean that inevitably investments always revert back to their mean or average rate of return over time, which for stocks is right around 10%. So the fact that we're right back there, not super surprising, but I think that what we're seeing right now, and I know I've gotten a lot of questions from people here over the last couple of days. One of the reasons I'm putting this this video out here over the weekend, just to answer more questions if you haven't been paying attention to the news the last couple of days. But right now, I think we're in a ride it out mode, because what we're seeing right now is definitely self-induced because of the tariffs that President Trump's put into place. These are all different things that can really be impacted pretty dramatically by the Federal Reserve. And I talk all the time about why the Federal Reserve is way more impactful to the economy than anything any president is ever going to do, including tariffs. Because if the Federal Reserve decides that they are going to drop interest rates, what you're going to see is markets rebound, because the interest rates are pretty high, relatively speaking, in the last 10 years because of where we were just a few years ago with inflation. So inflation has come down pretty significantly. And if inflation continues dropping off, it'll allow the Federal Reserve the opportunity to lower interest rates, which is going to be a very good thing for the overall economy and stocks especially. So there's specific parts of the stock market that will do better when interest rates come down. Technology, which is getting really beat up recently, a lot of it because of the concerns of tariffs. Your areas like semiconductors, which are a subsector of technology that we have if you have an IRA with me or Roth IRA, you have that in your portfolio, as well as home construction. One of the areas, the bright spots here today, is home construction, which if I'm looking at my charts here, home construction, when I looked earlier, was up about 1.5% today, and which is pretty, let me see where it's at right now. We're up about actually 3% right now. So home construction went down. The home construction fund is just an area that is invested a lot in companies that have their hands in the home construction industry. So these are like D.R. Horton, Lennar, Pulte Group. Those are all companies that basically build homes. Then there's your Lowe's, Home Depot, Sherwin-Williams, those types of companies. Those are doing really, really well because of the outlook on interest rates. With interest rates dropping, that's a lot better for people that are looking to buy houses, because that means mortgage rates are dropping alongside of it as well. Really good for home construction. So that's about 4 to 5% of most portfolios that are in IRAs. So that's done really well. But if we continue getting interest rate drops, that's going to do even better. One of the reasons I have that in portfolios is from a long-term standpoint. I think that's an area of the economy and the stock market that is really undervalued. But bigger picture thing for those of you that are very concerned about what's going on in the markets over the last couple of days, the last month and a half, is, are we safe? Are we, especially if you're retired and you're relying on this money for income? Remember, the way that I've set your portfolio up, there's a portion of it that is in stocks, probably 60%, maybe 70%, depending on your risk tolerance overall. But the other percentage of it, that 30-40%, that money is held in those option-based strategies, those buffered strategies I talk about, that hedge market drops. A portion of it's held in short-term treasury bonds. So that portion is pretty safe and secure. And the reason that I have that in that part of the portfolio is for times like this, that when markets do go down, you're not dropping off, your whole portfolio isn't dropping along with it. So the way that I look at a portfolio like that is that if you're retired and you're pulling income from a portfolio, that you might be taking up to, say, 5% a year from a portfolio. So if you're pulling 5% a year and 40% of it is protected against market drops, that means that we have a pretty long runway to just keep withdrawing that money and not having to worry about, tapping into the principal of that portion of the portfolio, while we let that other 60 or 70% that's held within the stock portion of the portfolio, while we allow that to fluctuate, because naturally times like this happen. It's not the first time that, if you've worked with me over the last handful of years where stocks have dropped off like this. It's definitely not going to be the last time we're going to see a number of these, over the rest of your lifetime. And that's a good thing, because that's where you make more money long term. So one of the reasons that stocks, their returns are 10% is because of volatility like this. But that 60, 70%, that's the money that we're not looking to touch for 5 to 10 plus years anyway. So we can allow that to sit there, fluctuate, do its thing like it's doing right now. And, it allows me for opportunities to make changes within there as the market, like it has given, opportunities right now. But that money that's more conservatively invested, still there, still, safely protected. It's not fluctuating down to the same degree as the overall market. Each of the buffers and the option-based strategies work a little bit differently. So some of them protect the first 15% drop. Others, there's another one in there that it takes out the first 10% drop that we take that on as the investor, but then after 10%, it's protected. So that position, stocks could drop off 50%, you're down 10. So, and then there's a short-term bond portfolio in there that makes about 4 to 5%. That doesn't go down ever because it's short-term treasuries. So, that's for those more conservative portfolios, that's 5% of that whole portfolio, which I have set as 5% because realistically, you don't want to be taking much more than 5% per year. So that's the entire amount that you would take in 1 year's time frame. So, just to kind of give you a little bit of the under the hood of portfolios, what I'm doing, behind the scenes with that, and, try to alleviate some concerns that, a lot of you may have out there. One of the other little tidbits I would say that would be really mentally helpful for a lot of you out there is, turn off the CNN, turn off the Fox News. It's definitely not going to help you out from a mental standpoint with your investments because, again, if you understand what media outlets are created for, isn't just giving news, it's selling ads. And times like this, it's, one of the easiest things they can do is drum up fear because fear is it creates a very emotional response. And if they're drumming up more fear, they're going to get more eyeballs on their network, watching their shows, viewing their content if you're looking at it online. It's not good for you though mentally, and it really works opposite emotionally what you want to be doing with your investments. Because if you take yourself outside of looking at the dollar amount of your portfolio and you just think about your investments or investments as a whole rationally, would you rather pay 17% more or 17% less for an investment? And you could take that and use this. Would you rather pay 17% more or 17% less for a car, for a pair of shoes, clothes, whatever it is? And of course, everybody's going to say, of course, less. And when it comes to investing, the hard part is that when you look at a portfolio and it's down 17%, you don't feel like you're getting a bargain. You feel like you've just lost a bunch of money, when in reality, if you haven't sold it, you haven't lost anything. And, part of investing is going through those fluctuations and allowing an investment to grow and fluctuate over time, because it's the price that people perceive the company being worth today, currently at this exact moment in time during the market trading days. Doesn't mean that price is accurate necessarily based on truly projections of how well that company's doing and is gonna do into the future. So that's why, riding through, big extremes like this is really important. So I have a few charts that I'll dive into as well that I think are important to look at and talk more about this, and I'll hit home a little bit more of these points I'm talking about. One of them is looking at the S&P 500's performance after closing correction territory, which this goes back through the great financial crisis of 2007 to 2008. If we look at the charts there on the top, it shows the dates on when we entered the correction. So a correction is when stocks drop from a high down 10%. So once it goes from that high down 10%, which we had entered a correction last month, and then obviously we're continuing that even further here this month, but we had entered that last month, and then markets rebounded a little bit, and then we dropped off here obviously over the last few days and week especially. So if we look at this, 1 week after entering a correction, kind of mixed results. Some time frames are a little bit better than others, but 67% of the time, markets are positive. The median return on that's 1.5%. Fast forward out a month, 40% of the time, even more mixed results of that. We go out 3 months, a little bit less. 60% of the time, again, stocks are higher. We go out 6 months, 73% of the time stocks are higher. We go out 1 year, 86% of the time stocks are higher. The only 2 times since the great financial crisis that stocks were down was, during the great financial crisis, which, that was a pretty extreme time frame. Stocks from the peak to the bottom, from the peak of 2007 through the bottom of March of 2009, we're down 57%. So pretty dramatic. Like if you think about that in dollar cents, that's $100,000 dropping down to about $43,000. So pretty extreme. Also, if you're then thinking, if your mind goes there, if you're then thinking like, well, that could happen again, the reality of that happening again is like 0.00 because of the intervention that the Federal Reserve and the government would do. Case in point of that was COVID. And the reason that we had the inflation that we had was because the Federal Reserve and the government was over responsive with stimulating the economy because they learned from what happened during the great financial crisis when it came to stimulating the economy, lowering interest rates, doing quantitative easing, instead of what they did during the great financial crisis where they spread it out over a number of years. During COVID, they just threw it all at us as, the American people and the economy. And that really helped out with shortening the window of the recession because of COVID. One of the things that the Fed would be likely to do again if we were to enter some more extreme time frame like that would be, overstimulating the economy to a degree, because COVID and the results of inflation was a lot better than what happened during the great financial crisis, because that bled on for, close to a decade because of, having, the slower response that the Federal Reserve and the government had at the time. But this was a good chart, though, I wanted to bring up just because I'm not just pointing out a year later that 86% of the time that stocks are higher, which pretty good odds. Typically, stocks over on an annual basis are up 75% of the time. Those are just, normal statistics. So obviously going into correction territory, the likelihood of stocks being positive a year later, even better. But the part that I really looked at here that was, more important to me was the average and median returns a year later were 15 and 18%, which are, markedly above what they historically are at around 10%. So reasons that, I would suggest we just, stay the course. Some of the changes I've made within there, I've already made within, earlier on this morning and a little bit yesterday. So a few things that you can do, or we could talk more about if you'd like to, because one of the hard things I know when, stocks drop off like this, you see portfolios drop off, is you feel like you need to take action. The best thing most of the time to do is literally just sitting on your hands, which is one of the hardest things to do when it comes to investing, because you feel like you should just be doing something. And your natural reaction is to just cut the losses, stop the bleeding, which, if you peel back the emotion on that, is the opposite thing of what you want to be doing, because what you really want to be doing is probably either adding more to it or becoming more aggressive within a portfolio. Those are 2 of the 3 things I would suggest doing right now. And third thing that if we haven't talked about it, it might be an idea that we do talk about a little bit more, would be doing Roth conversions. This is where I know I've done this with a number of you. We did it back in 2022 when stocks dropped off at that point. But I hadn't done it with a lot of people in the last couple of years because we've been at new all-time high after new all-time high. One of the reasons that you want to do a Roth conversion, what a Roth conversion even is if you have a traditional IRA, all that money in there is pre-tax. So what we can do is we can take a portion of that money and convert it to a Roth. That's where we take the money out. It creates a taxable event where you owe taxes on that withdrawal, but then we put it in the Roth IRA, where then when that money then rebounds, all of the growth on that money is then tax-free. So versus if it stays within the traditional IRA and it just rebounds back, then all of that then growth is taxable still. So creates a good opportunity with markets being off pretty dramatically in a short time frame like this to do things like Roth conversions. A few factors, and this is just something we would need to have a deeper conversation about just to make sure that it's right for you and talk through the amounts. But where your tax bracket is now, where it's going to be in the future, that's an important thing. Definitely figuring out what your age factors into it, because maybe you're closer to retirement where all of a sudden you're going to be retired and making a whole lot less money in the future and you're in a higher tax bracket now. There's a number of factors. I won't list all of them, but if you're thinking that might be something you want to do, reach out to me. It's definitely a timely thing. And it's also kind of time sensitive, because one of the things that I wouldn't be surprised about is if we look at what happens next week. I wouldn't be surprised if we get some type of relief rally where stocks rebound back because of some news over the weekend that, China or whoever comes to the table and wants to negotiate tariffs with President Trump or whatever it may be. A lot of different things that could happen. But from a timely standpoint, definitely something that if you're thinking about doing Roth conversions, definitely, good time to talk about it. Last chart that I have here, I thought was, a good chart kind of putting everything in perspective, is showing returns on the stock market here going back through 1870 and some of the fluctuations that we go through. Bigger thing I really want to point out, this highlights a lot of the bigger events that had happened economically. Like we had the lost decade from 2000 through 2009, 2010. Then we had, prior to that, Black Monday, you have Vietnam, inflation, Watergate, all of that. That was a pretty big time frame. So thing I want to point out, though, is that we can see certain trends that are happening. If you key in the late 1800s, the market was up for really, if we look at, there's, definitely some drop-offs in there and stair steps going higher. But as a whole, the market really moved up for about like 30, 40 years pretty dramatically. And then we went through, a drop-off in the 1910s that then culminated after World War I. And then we then had a 10-year up period, which then culminated with the Great Depression, which was, the worst economic time frame in the last 150 years. And really, we didn't get out of that until World War II. So there was, large, 20, 30-year upspan, which then followed by a 10-year downspan, 10-year upspan followed by about a 15-year sideways movement from the Great Depression through World War II. Then we had 20 years up from 1950 through 1970, 10, 15 years sideways, 20 years up, 10 years sideways. If history is repeating itself, we're in the midst of another, really 20 to 30 plus years higher. So there's always going to be blips along the way, which we can see throughout history. But one of the reasons I would definitely impress upon all of you that are watching this, you want to be invested in stocks. If you have a 5+ year time horizon, you want to have, a significant amount held within stocks. If you have a 10+ year time horizon, you probably want to have the majority of your money held within stocks, because we're going to see a lot higher rates of return. The average of 10%, I think, is going to be the low end of what we'll see from, especially this point moving forward because of the drop we've just had. So I thought that was an interesting chart just to kind of put everything in perspective, peel back some of the emotion and, maybe alleviate some concerns that you all have out there. These are things that happen periodically within the stock market. It's not fun. It's not enjoyable. I don't like it. It definitely sucks seeing portfolios, drop off like this, but that's what we get when we invest in stocks. And, that's also what we get with the returns over time too, being dramatically higher than every other asset class out there. So, that's one of the reasons why I have such a large portion of your guys' portfolios held within stocks, because long term, I know that we're going to make more money and that this is just, another bump along the road to making more gains over time. So if you have specific questions or you want to get together with me, one-on-one or catch up via Zoom or over the phone, call me, text me, email me, whatever way works best for you. I'll be more than happy to talk with you more in depth. If you have people out there that don't hear from their advisor ever and would like to have a conversation, I'd love to have a conversation with those people as well, help them out with their portfolios. But I appreciate you all taking the time to check me out. Until next time.